Welcome to a fund review series by All Taxes. I'm Yogesh, founder and CEO of All Taxes. This is a very special video because it's not a traditional PMS. It's a category 2 AIF, and importantly, it does not invest in equities, derivatives or SMEs. Instead, it's a private credit focused on special situations. At All Taxes, our job is simple. We identify PMS and AIF strategies that not only outperform the benchmarks historically, but have the highest probability of sustaining that outperformance going forward. To do this, we follow a rigorous 30-point proprietary checklist that deeply analyzes the fund manager, historical performance, investment philosophy, portfolio construction, and risk metrics. If you're currently evaluating a PMS or an AIF and want a data-backed, unbiased view before investing, you can book a call using the link in the description. With that, let's dive straight into the fund review. One of the leading fund houses in India in private credit is Neo Asset Management. Neo manages close to $2 billion in private credit across multiple strategies, including special situations and income-oriented funds with varying yield profiles. The fund we're discussing today is Neo Special Credit Opportunities Fund Series 2. The first fund in the series is already fully subscribed, deployments are complete, and investors have already started receiving healthy cash coupon payouts of around 16% per annum. Special situations credit is a relatively new asset class in India, so understanding where the money is deployed is critical. One of the largest opportunities is acquisition financing. Banks typically avoid funding acquisitions, especially leveraged ones. This creates a strong opportunity for private credit funds to provide secured loans to companies acquiring smaller businesses. Another key area is promoter financing. When promoters want to increase their stake in their own company, they often require bridge financing until private equity investors or banks step in. The third major opportunity is working capital financing against trade receivables, particularly where the end customers are large, well-rated corporates. According to the fund, this represents a 2 lakh crore opportunity and the market continues to expand every year. This strategy has delivered strong risk-adjusted returns. The previous fund generated 23% gross IRR before fees. What makes it particularly attractive is the quarterly cash coupon structure, which provides regular income visibility. Naturally, investors ask whether this is risky. The fund mitigates risk by lending only to EBITDA positive companies, ensuring minimum 2x collateral coverage, acting as the sole lender, giving them strong control and recovery rights. In volatile equity markets, where long-term equity funds return around 12 to 14% with high drawdowns, private credit funds offer a way to earn similar returns with significantly lower volatility and predictable cash flows. Neo follows a strict credit underwriting framework. They invest only in companies with a strong repayment history, debt to EBITDA capped at around 4x, consistent and predictable cash flows, and positive EBITDA for the companies. For a credit fund, cash flows and repayment discipline are paramount. While the risk is higher than fixed deposits, the trade-off is meaningful. FDs offer a 4 to 5% return, whereas special situations credit funds can deliver around 12 to 14% post-tax. In the first fund of the series, nearly 2,000 crores were deployed. Around 500 crores has already been returned to investors via cash coupons. 26 investments were made, and the fund achieved a gross IRR of approximately 23%. These are short-term duration loans, typically 12 to 18 months, not long-term capital loans. Cash coupon distributions have been extremely consistent. The first fund delivered 4 to 5% quarterly payouts, excluding capital repayment, which investors receive at the end of the fund tenure. This regular income profile is one of the biggest attractions of private credit strategies. The fund, currently open for investments, is Series 2. The target fund size of the fund is 5,000 crores with a minimum investment of 1 crore rupees. The capital is not required upfront. It's a drawdown over 18 to 24 months, with a target portfolio of around 25 to 30 investments. And the expected gross IRR is 21 to 23%. Importantly, the fund invests in only secured loans, not unsecured or pure cash flow based lending. This provides strong downside protection and multiple recovery options in case of stress. Putting it all together, the Neo Special Credit Opportunities Fund offers a compelling way to participate in India's growing private credit market through a disciplined, secured, and yield-focused strategy. To summarize, the fund gives an exposure to fast-growing special situations credit opportunities in India, strong risk controls with collateral-backed lending, consistent quarterly cash coupons, and an attractive risk-adjusted return profile in volatile markets like these. This is why private credit strategies like this are increasingly becoming a core allocation for HNI investors. seeking stable, predictable returns. That said, every alternate investment suits a different investor profile. To understand whether this fund is the right fit for you, you can book a call through our website today.